Historical performance. The S&P 500 has historically delivered strong long-term returns, averaging roughly 7 to 10% annually after inflation over extended periods. However, returns vary significantly in the short term. Major historical phases. Post-World War II expansion, 1950s, 1960s strong industrial growth. Stagflation, 1970s weak performance due to inflation and oil shocks. Tech boom, 1990s rapid growth led by technology stocks. Dot-com crash, 2000 to 2002 major correction in tech valuations. Global financial crisis, 2008 sharp decline followed by recovery. Bull market, 2009 to 2021 one of the longest bull runs in history. Post-2020 era, driven by technology, AI growth, and inflation cycles. Despite crises, the index has historically recovered and reached new highs over time, reflecting long-term economic growth. Role in global markets. The S&P 500 is not just important in the United States, it is a global benchmark. International investors, sovereign wealth funds, and central banks often track or invest in it because it reflects the largest economy in the world. It includes globally dominant corporations. It provides liquidity and stability compared to smaller markets. Movements in the S&P 500 can influence global markets, including Europe, Asia, and emerging economies. Investment through index funds and ETFs. Most retail investors access the S&P 500 through index funds or ETFs, exchange-traded funds. These funds replicate the index's performance. Common benefits include diversification across 500 companies, low expense ratios, long-term stability, passive investing strategy. Instead of selecting individual stocks, investors can buy exposure to the entire index. Advantages of the S&P 500. 1. Diversification. It reduces risk by spreading investments across multiple industries. 2. Transparency. The index methodology is publicly known and regularly reviewed. 3. Strong historical returns. It has consistently grown over the long term. 4. Market representation. It covers approximately 80% of the total U.S. equity market capitalization. Limitations and risks. Despite its strengths, the S&P 500 has limitations. 1. Concentration risk. A small number of large tech companies often dominate index performance. 2. U.S.-only exposure. It does not include international companies, so investors may miss global diversification. 3. Market volatility. It still experiences significant downturns during recessions or crises. 4. Passive exposure to overvalued sectors. Since it is market cap weighted, overvalued companies may gain higher weight. Why it matters today. In modern financial markets, the S&P 500 is more than just an index, it is a financial barometer. It reflects investor sentiment, corporate profitability, interest rate expectations, and global economic trends. For example, rising index optimism about corporate earnings and economic growth. Falling index concerns about recession, inflation, or geopolitical risk. It is frequently referenced in news headlines, investment discussions, and the S&P 500 is one of the most important benchmarks in global finance and is widely used to understand the performance of the U.S. stock market. It represents a broad cross-section of the American economy and is often considered the best single gauge of large-cap U.S. equities. What is the S&P 500? The S&P 500, Standard & Poor's 500, is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. These companies are selected by a committee at S&P Dow Jones Indices based on criteria such as market capitalization, liquidity, profitability, and sector representation. Unlike a simple list, the S&P 500 is market cap weighted, meaning companies with larger market values have a greater impact on the index's movement. For example, a 5% move in a megacap company like Apple will influence the index far more than a 5% move in a smaller constituent. Purpose and importance. The S&P 500 serves several key purposes. ###1. Benchmark for performance. Investment funds, mutual funds, and portfolio managers often compare their performance against the S&P 500. If a fund returns 10% while the S&P 500 returns 12%, the fund is said to have underperformed the market. ###2. Economic indicator. Because it includes companies across multiple industries, technology, healthcare, finance, energy, consumer goods, the index reflects the overall health of the U.S. economy. ###3. Investment vehicle. Many investors do not try to beat the S&P 500 but instead invest in it through index funds or ETFs such as those tracking it directly. This allows diversification across 500 companies in a single investment. ###composition of the index. The S&P 500 includes companies from all major sectors: information technology, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, energy, utilities, real estate, materials. Technology companies typically hold the largest weight. For example, Apple Inc., Microsoft Corporation, NVIDIA Corporation, Amazon.com Inc. These companies alone can significantly influence the index due to their massive market capitalizations. ###how companies are selected. To be included in the S&P 500, companies must meet several requirements. 1. Market capitalization, typically tens of billions of dollars. 2. Liquidity, the stock must trade actively with sufficient volume. 3. Domicile, must be a U.S. company. 4. Public float, a significant portion of shares must be publicly available. 5. Profitability, must have positive earnings in recent quarters. A committee reviews and adjusts the index periodically to ensure it remains representative of the U.S. market. How the index is calculated. The S&P 500 uses a free float market capitalization weighting system. This means each company's weight equals market cap of company divided by total market cap of all 500 companies. Only publicly available shares are counted, not insider holdings or rest. The S&P 500 is one of the most important and widely followed stock indices in the world. It captures the performance of 500 leading U.S. companies and serves as a key benchmark for investors, economists, and policymakers. Its strength lies in its diversification, long-term growth history, and representation of the U.S. economy. While it is not without risks such as concentration in large tech companies and exposure only to U.S. markets, it remains a cornerstone of global investing. For most investors, understanding the S&P 500 is essential because it is not just a measure of the market, it is often treated as a measure of financial confidence in the United States economy itself. The S&P 500 is a major U.S. stock market index that tracks the performance of 500 large publicly traded companies. It is widely considered one of the best indicators of the overall health of the U.S. economy and stock market. The index includes companies from many sectors such as technology, healthcare, finance, energy, and consumer goods. Well-known firms like Apple Incorporated, Microsoft Corporation, Amazon.com Inc., and NVIDIA Corporation are among its top components. Because it is weighted by market capitalization, larger companies have a bigger influence on its movement. The S&P 500 is used by investors as a benchmark to compare portfolio performance. If an investment performs better than the index, it is considered to have outperformed the market. It is also a popular choice for passive investing through index funds and ETFs, which allow investors to own a small share of all 500 companies at once. Historically, the index has delivered strong long-term returns, although it can be volatile in the short term due to economic events, interest rate changes, or global crises. Overall, the S&P 500 is an important tool for understanding market trends and long-term investment growth in the United States. The S&P 500 is a stock market index in the United States that tracks 500 of the largest publicly traded companies. It is one of the most important indicators of the American economy and is widely used by investors around the world to understand market performance. The index includes companies from major sectors such as technology, healthcare, finance, energy, and consumer goods. Well-known companies like Apple Incorporated, Microsoft Corporation, Amazon.com Inc., and Nvidia Corporation make up a significant portion of the index due to their large market values. The S&P 500 is weighted by market capitalization, meaning bigger companies have more influence on its movement. For example, if a large company's stock rises or falls sharply, it can significantly impact the entire index. Investors use the S&P 500 as a benchmark to measure performance. If a portfolio performs better than the index, it is considered successful compared to the market average. It is also popular for passive investing through index